Hi, this is Gary. In this tutorial we are going to take a look at how an option works, and we will also take a look at how the premium changes with different factors. To start off, an option grants the holder of it the right but not the obligation to buy the underlying asset from another party at a fixed price over a specific period of time. What that looks like, I have a chart drawn right here. We're going to start with an example, and since we're doing call options, and in this example we buy a call option for $1 that expires in, we'll say, X months. It could be any number, and it gives us the right but not the obligation to buy stock for $10 a share. So I'm going to change my units here to dollars, and we're going to do a profit loss diagram here. To start off, we have the loss, and that is $1, and that is for any time the price of the underlying security or the equity at expiration is less than $10, because that's our exercise price right there. So essentially we have a $1 loss until the price goes over 10. We start to recoup some of our premium cost, and we get to this point right here called the break-even point, which I've highlighted right there, and that's the point where we actually start seeing a profit. So theoretically, the higher a security or a stock goes, the more money we could make on this. So theoretically, there's potential for unlimited profit. In this case, we have a break-even point of 11, and of course our strike price is at 10. But once the price goes over 10, theoretically we can make any amount of profit depending on what happens to the underlying security. So that's one of the advantages of an option. Now obviously most options expire worthless. And that is from the buyer's PL, or profit loss side. Now let's take a look at this from the seller's PL, or profit loss. And if you intuitively guessed that it would be the inverse of the buyer's profit loss, you are correct, and I will draw that right here. The further out we go as far as security price and equity price, the more the seller loses. But as long as the price of the security stays below the strike price, the seller is going to be profiting the $1 premium. And we're going to take a look at a real example here of how options work. Now I have Yahoo stock here, which at the time on April 3rd was priced at $23.39, and I'm going to walk through some of the factors that affect the premium price here. The first factor that affects the premium is exercise price. Now, the higher the exercise price, all else being equal, the lower the premium. So that the higher the strike price or the exercise price, the lower the premium is going to be. Another factor factoring the premium is time. And essentially with time, the further out we go, I've got it in green here, the higher the time premium is going to be, or the higher the time component of the premium is going to be. Conversely, the longer we hold an option and the closer it gets to expiration, we're going to have a thing called time decay, where time is actually, the premium portion is going to head in the opposite direction. But the further out we go in time-wise, the larger the premium is going to be. The next factor we have here is I call RFR, or the risk-free rate. Now interest rates is how we can think of this, and as interest rates rise, the higher the premium for an option is going to be. Another factor affecting the premium is the stock price. The higher the stock price, the higher the premium. Another factor that affects the premium is volatility, or I have a line here called drawing for it called standard deviation. Now, the higher the volatility, the higher the premium. I've circled here an area where there was a lot of volatility, and conversely, when options were put out that time, they probably had higher premiums than this other period. We go to 3 years later, where there's much lower volatility, and that typically would equal a much lower premium. Now we're going to take a look at some strike prices of calls here. I have puts as well, but I'm going to zoom in on the call stuff. So you can see the current stock price at the time of this was $23.39, and I'm going to try to zoom in here, and hopefully it comes in clearly here. Now we have these transactions cost that make options kind of like ice cubes. Or the longer you hold them, the quicker they evaporate, and you'll see why in just a second. First off, you have your standard commissions you'd pay through a brokerage firm. Next, we have this thing called the bid-ask. The ask is where you buy the option, or the price you buy the option for. As you can see on the one I highlighted, the ask is on this leap here, and these are leaps from January 15, or January 2015. As you can see on this ask here, that's what you buy it for, $18.45. Now, the bid I've circled in red is the price you could sell it for, and the bid on this one is $16.35. So, as you can see, just making a round trip, you're going to lose a lot of money. Now, another thing we look at with options, or that affects the bid-ask spread, is called volume, and I've highlighted that in green here. If you'll notice, the part I've highlighted in black has the highest volume, and consequently it actually has one of the smallest bid-ask spreads, and that's due to liquidity. Typically speaking, the more volume an option has, the more liquidity, and more liquidity typically translates into lower bid-ask spreads. Now we're going to take a closer look at how premiums work, or how they're priced. I'm going to zoom in on this so we can get a better view of that here. Now, the pink line I have here is typically what you might expect a premium to be at a given price of the option, and obviously it has many different factors that we've covered earlier that affect it. What I want to do is take a look at a couple more factors involved in the premium, and typically it's going to be the widest around the strike price. So the closer we get to the strike price, the larger the premium component of the option price is going to be. And as I've highlighted in red here, the premium is going to narrow as the stock price moves away from the strike price. So the further away from the strike price we get in either direction, the smaller the premium is going to be for an option, because there's less uncertainty in that situation, or those situations. Now, what I have here is delta. Now, delta is going to measure the change in the option price divided by the change in the underlying price. So, when you see a delta, or when somebody's discussing the delta of an option, they're basically discussing how much does that option price change with respect to security price move. So, like, I'm going to highlight in white here. If the security price goes from this point to that point, the question is how much will the option change? I mean, the option's not going to change by the same amount. let's say, I mean in this case the stock went from, underlying stock went from like 10 to maybe 13. Well, the option's not going to change from 1 to 4. It's going to change somewhere in between there because we have to factor in the delta. Conversely, I have on the left, on the lower left, drawn a white line, where if the stock went from, let's say, 2 to maybe 450, at that point the delta is going to be different than the previous example I gave you. Now moving on to the next measure, which is called gamma. And gamma essentially measures how sensitive the delta is to a change in the underlying price. So I've highlighted here in green our strike price, and typically a gamma is going to be the largest at the money, or when an option's close to expiration, and it's close to at the money as well. And the reason is there's more uncertainty as to what the final payout is going to be, and that leads to a higher premium. And that concludes our tutorial on how call options work. Thank you for watching.